Good morning, everyone, and thank you for joining me. This is Kathryn JohnBull. I'm the Chief Financial Officer of DLH Holdings Corp, and I'm here this morning to update you a bit, to update some of you who know us and introduce those of you who have not yet known us to DLH. This is our usual forward-looking statement in terms of our public company data and context for you of our securities filings. I appreciate your taking time out to learn about us, and I'm bringing you greetings from Zach Parker, who unfortunately is not able to join us today. Zach's our President and CEO, and I'm the Chief Financial Officer. Giving you some context on the company was founded in 1969, so we just had our 50th birthday not long ago. Our headquarters are in Atlanta, Georgia. We have corporate offices in Silver Spring, Maryland, Durham, North Carolina, and Kampala, Uganda, for those of you who were trying to figure out what state was UG. We do also have project offices on the government sites in about 23 different locations. We are carried on NASDAQ under the symbol DLHC, have been public since '86, have roughly 2,200 employees in about 30 locations. Our offering, our service delivery is purely to the federal government, and we deliver services in the healthcare space of the federal government. We deliver in three major market areas: defense and veteran solutions, human services and solutions, and public health and life sciences. We provide technical and professional services in the healthcare space with enablement of a technology solution. And we'll get into that in some more detail on a later slide. So giving you some context for us, as I mentioned, we're a 50-year-old company, but the company's heritage was established as a commercial enterprise, and with principally focus on temporary staffing, both in a generic temporary staffing market space and in the healthcare temporary staffing in the commercial markets. Along the way, the company accomplished an acquisition of a government services healthcare provider, temporary staffing. And in 2010, the company was restructured to divest all of the commercial operations and focus exclusively on providing government services. And so at that point, with the change in emphasis from commercial to government services, we installed new leadership, enter Zach as the CEO, and then I joined the team in 2012. So the opportunity at the time we joined was really to, first of all, turn the company around. The company had really not been able to gain traction and any kind of significant market presence in the commercial staffing arena. However, had some pretty good performance credentials and good customer acceptance in the government services space. And so with that emphasis and focus on government services, our challenge was to first stabilize the company, turn it around to operating profitably, and then build. And so it's been an exciting journey in the 10 years that Zach's been aboard and the 8 that I've been a partner with him. And you'll see how we've progressed over time. But we set about on a journey to take the base of business that was temporary staffing in nature that we inherited to operate and really transform the company to be more what our background experience was, which was long-term, long revenue visibility, critical mission delivery of a portion of services for the government, the various government customers, rather than just sending them temporary staff that they provided direction and expertise to. So in that context, after we stabilized the business we inherited and began to think about what the right markets were to pursue, we began an acquisition program. And the first of those acquisitions happened in 2016. We acquired Danya, which gave us our first footprint in health and human services, with our heritage coming from Veterans Administration. We then branched out to Health and Human Services in 2016 with that acquisition. Along the way, we continued to build our credentials and prepare ourselves to assume responsibility for more broad and differentiated tasks and providing direction and leadership to the government programs that we were pursuing. We next then acquired a position in public health and life sciences with our acquisition of social and scientific systems in 2019. And then finally, most recently at the very end of last fiscal year on September 30th of 2020, we acquired Irving Burton and Associates, which gave us an extended footprint in defense health. So by now we have built our position in those three markets that we talked about on the previous page and really rounded out our presence in those key three federal healthcare markets. The core customers within those health markets, those federal markets, there are dozens of agencies and sub-agencies, but our primary focus is on the ones that have the pole position, if you will, on very key, very large scale and high impact healthcare program delivery for major parts of the citizen population. So our core customers include the Department of Veteran Affairs, Health and Human Services at the parent agency level, and then within Health and Human Services, we also, of course, support the National Institutes of Health, which is getting a little bit of attention these days. We also support Centers for Disease Control, the Administration for Children and Families, which is within Health and Human Services, the Department of Homeland Security, Defense Health Agency, and the Department of Defense. So those are, there are, as I mentioned, myriad government agencies. Our strategy is to remain focused on a relatively smallish number of agencies that have broad reach and very large programs that they're executing. We provide that service delivery of programs with some technology enablement. Key among those would be our evidence-based decision-making tools that support data analytics on these very large-scale programs. In many cases, we're implementing the solution that is doing the data analysis on program support. As a particular instance, we did implement a data analytics program on a large Health and Human Services project that we manage that has mobile enablement. So it's really key in terms of being able to deliver cost-effective program support that you have a very strong grasp of technology enablement. Additionally, we offer cloud migration and computing services, particularly through our infrastructure program where we offer a FedRAMP certified secured solution for data storage and data accessing and process. So if you follow our press releases, you'll see that we announced about a year ago that we achieved FedRAMP ready status. We're one of about 100 companies that have an offering in that status. And our offering is generally broader than most offerings. In many cases, you can get certification for a small subset of your offering. We have a platform as a service offering that includes every aspect of data management, data security, and data processing capability for our government customers, particularly those that have petabytes of data that they're processing to analyze healthcare trends and healthcare epidemiological statistics. Just featuring a little bit more fully, if you have encountered us before, you would remember that one of the open loops we had on rounding out our portfolio was a position with Defense Health, and our most recent acquisition rose to the top of the stack for us because of its presence and heavy experience in Defense Health. Irving Burton is a 40-year-old company that has strong connection to both Defense Health and to the USAMA at Fort Detrick. Both of those are very at the forefront in terms of the agencies leading the technology-enabled healthcare delivery to active duty military. And so from our perspective, they had a very strong connection to major customers we were in pursuit of, but also brought to us additional technical capabilities that were important to us, that we were already in the process of developing our strategy around. And so augmenting that with the experiences that Irving Burton brought both in AI and artificial intelligence and machine learning was really important to being able to accelerate our technology delivery, both on their current programs, but more importantly, across additional programs that we are in pursuit of. You won't be surprised to know, since we're a healthcare delivery company for the federal government, you won't be surprised to know that we are significantly impacted, both from an opportunity perspective and a little bit of a challenge perspective, impacted by the pandemic. Clearly, in the net, we view the pandemic effects as a net upside to the company, just in terms of our deep skills and long-standing service delivery in the public healthcare space. So we do have an expanding portfolio of our mission-critical related services across these key government agencies. At the forefront of that, of course, is the public health and life sciences part of our business. Our primary customer within NIH is NIAID, led by Dr. Anthony Fauci, who everybody on the planet knows who he is by now. But he is at the forefront of vaccine development, and we are deeply connected to the work that they're doing in terms of testing therapeutics and providing analysis on those clinical studies and helping in addressing the triage phase of COVID response that we're currently in. We also expect, of course, down the road, once we exit the urgent part of COVID and really start to look at its long-term effects and how it might interact with other challenging health circumstances of people with long-term health care issues like diabetes or COPD. There is, we believe, significant additional opportunity in providing support for those follow-on studies once the triage part of COVID is behind us. In balance, though, there is, of course, some balancing offset or downside to COVID, as it is for every commercial enterprise. We have had some impact to our current operations from closure and limitation of ability to travel to facilities to perform, particularly in the part of our work that is compliance and monitoring by visual site inspection. Much of that work we had already, from a cost effectiveness, been moving to a virtual setting. But some of it, at the end of the day, the customer just wants eyes on the facility and wants to observe that compliance is occurring according to their expectations. And of course, to the extent we haven't been able to do that travel, we've had some impact. The places we're investing to really manage our way through COVID and its impact. Of course, we have people working these programs, and we clearly depend upon the ability to protect the health and safety of our workforce in performing those services. Many of our workforce, roughly more than half of our workforce, is working frontline in terms of prescription delivery on behalf of the Veterans Administration. So that's clearly something that can't be done in a remote work from home environment. So, we have to arrange the workplace for them to make sure that we minimize exposure. And we do that via the advice of our COVID-19 Executive Task Force, where we leverage the skill sets of our chief scientists and our MDs on staff and our masters in public health people with epidemiological focus to help us provide direction and really minimize the opportunities for COVID impacts to our workforce. We also have implemented, to the extent possible, telework opportunities for people and remote workforce configuration so that we can continue to manage our business in the COVID environment. We do see opportunities, as I mentioned earlier, for significant growth and acceleration of growth. We've added leadership talent, most recently within the last 6 months at the Chief Growth Officer level and in the leadership level for our public health and life sciences practice area. So both of those have significant opportunity to accelerate our growth and really drive us forward more quickly than before we added them to the team. We believe that as we continue to evolve our differentiated solutions through key technology enablement, we'll continue to accelerate our growth. And then finally, continuing to deploy our secure large-scale data analytics platform. It is, as I mentioned before, a solution for our current public health and life sciences clients, but we see major government-wide health IT initiatives that we expect are going to leverage that capability. Additionally, we combine that capability with our other IT skills in Agile and DevOps and AI and ML and all those things knitted together as a solution, we expect will significantly augment our ability to pursue more differentiated offerings. We have a good track record so far. It's been a quick 8 years that I've been associated with the firm. And of course, coming in, the job one for us was to really get enough critical mass to really diversify the business and move away, retain the business we had with VA, but move away from just that as our single channel for service delivery and broaden our reach across those 3 key markets that I described at the outset. Diversifying, as we do that, we're moving up in the value proposition and moving away from providing staffing resources of a trades-based nature to more skilled level resources that have advanced degrees and significant subject matter expertise in the areas that we're pursuing. The trend you see here doesn't, by the way, include any delivery from IBA since we closed it on the last day of the year. As we're growing, we are moving up the EBITDA delivery, and we're moving from roughly, in the first year reported here, about a 1% EBITDA margin to most recently 10% EBITDA margin, which if you study our sector in CapIQ or any other industry tools that are reporting on government services sector, the median EBITDA delivery is around 8 to 10. So we're on the healthy right side of that range of EBITDA delivery. And we've been able to accomplish that by, as I mentioned, moving up the value stream, offering more technically difficult and differentiated services, and then of course leveraging the corporate infrastructure that we had when we were a much smaller company. So those things have really been critical to our being able to deliver a more reasonable return and get in line with the metrics of the business, the industry as a whole. Along the way, certainly a good indicator for us and a metric of high interest to us is the quantum on our backlog. Our contract backlog is simply just the value of awarded work from our customers that we have not yet converted to revenue. And so you can see we started our fiscal year 20 at $414 million, which at the time was an all-time high for us, but we had substantial growth in that backlog during fiscal 20, both through significant major recompete of one of our anchor contracts with the Head Start program. Additionally, we acquired some backlog when we closed the acquisition at the end of the year, but then just basic growth of the programs and renewal of the programs that we had already under management also delivered a couple $100 million of revenue backlog. So all those things together, then reducing off the part of it that we converted to revenue within fiscal 2020, left us with an ending backlog balance of just under $700 million. And so from a top line delivery, that's slightly over 3 years revenue coverage. And from our perspective, finally gets us to that nice place where we have good revenue visibility and able to have a planning horizon that we think positions us well for continued growth. One of the key attributes of our government services sector is extremely cash flow positive. There's very little capital investment in the services business. And so our press is to deliver the services and convert it to cash, obviously, as quickly as possible. We typically carry day sales less than 60. We have been able to quickly accelerate our debt reduction as we've accomplished these acquisitions, which, by the way, those acquisitions have been completely financed with debt. We haven't taken any dilution in order to accomplish those. So we have been able to significantly and quickly on an accelerated basis pay off our debt by augmenting that with both tax. We've had favorable tax structure to the acquisitions in terms of creating deductible purchase price. And additionally, we had significant net operating losses from the period during which the company was losing money pre the transformation exercise that Zach and I came in to accomplish. So there were significant net operating losses from the 2000 to 2012 timeframe that we were able to leverage to accelerate our, reduce our tax liability and accelerate our ability to pay down debt. So we closed the deal on September 30th with levered less than 3 times, and we expect that we're going to go after this new debt as quickly and as aggressively as we have for the debt we took on during the S3 acquisition. So getting to what's next for us, and I think that's the end of my prepared slides, but getting to what's next for us, of course, as I mentioned at the outset, we've now rounded out the portfolio of the key market areas that we set out to pursue in 2016. Really what we see as the exciting next chapter for us is really taking those capabilities that have come to us via the various acquisitions we've done, and each of those acquisitions is independently operating very much in line with the expectations we had for them. But what we find as the exciting opportunity going forward is to take the capabilities of those acquisitions and cross-collaborate for the business and really pull all that capability to now pursue yet larger and more technically differentiated opportunities that we think will continue to move the company forward. So with that, I'm going to turn it over to Joe and allow you an opportunity for Q&A.
Thanks, Kathryn. Great presentation. Just very, very insightful. So I'm going to lead off here, with obviously some of the key questions relating to some of the, your big contracts. As everybody knows, obviously with the acquisitions, you've been diluting these, but the VA has been a significant contract for the company. It was for rebid. The VA took that back. Where kind of do we stand in the process there of when do they think they might be, or do you think they might be putting out, a rebid? Do we think that they're going to still need a veterans-owned business? Any insight into that would be appreciated, I think.
Mm-hmm. Yeah, so as you mentioned, so the VA contractor conducts through 2 different streams, one that is medically focused with pharmacists and then one which is more of a fulfillment logistics contract. So you're referring to the pharmacist contract, which was, that procurement was canceled last March, I believe. And not surprisingly, I think just, it was a little early to start to hunker down, but it is not unusual during the year of an election that things kind of, no major changes are undertaken generally at that time. So I'm expecting, there hasn't been any official announcement provided related to when they'll reopen that procurement, but it would be expected that with a change in administration and once those folks settle in and the cabinet officers get appointed, that would be up for review and consideration of what their new procurement strategy is. There's been a little movement in preparation of that, but no official guidance and no commitment to a timeline. So in the interval, they continue to bridge our contract and have us continue to provide services. But, the things that, of course, they'll have to think through as they develop that strategy is the volume of activity that happens through that program. And we deliver day in, day out on that program in excess of 700,000 prescriptions a day. And so you can appreciate that that's a pretty big ask for a small business to take that on. So we understand why it's something they have to reason through in terms of their procurement strategy. The companion contract, just to finish it off for you, the companion contract for logistics was also originally issued with a preference to small business set-aside status, and through their various stages of procurement evaluation, they've now concluded that there's not an appropriate awardee in any of those small business categories, and so they're now evaluating proposals from large, what's called full and open evaluation of proposals from large companies, including DLH. So that one's still under evaluation.
Okay, thank you for the insight there, Kathryn. And actually, we just got a question from the audience, which dovetailed right into the next question I was going to ask you, because you mentioned the new administration. And the question from the audience was, can you discuss the potential advantages and challenges to the company with the new administration? I know, historically there's been a lot of support for the programs that DLH is involved in. But maybe you could just talk a little bit more, give us a little more color there on what you guys see as potential advantages and challenges.
Certainly. Yeah, so we do, as you said, we do believe that, and the reason we're in the healthcare space is it enjoys broad bipartisan support regardless of which administration's in place. But generally speaking, conventional wisdom is that government programs are tend to be more strongly supported during a Democratic administration. And now when you layer on top of that the urgency of the COVID response, we do expect that there will be significant opportunities for growth. And we think that you saw that in the stimulus package that's been proposed with an additional $400 million for vaccines and testing, therapeutics, and just the medical response, in addition to another almost $400 billion. I think I said 400 million within the 1.9 billion that is focused on state support and helping those programs, helping the vaccines get that last mile into the arms of the people that need them. So we do think that with the change of administration, there'll be phenomenal opportunities to really go, I think everybody's kind of organizing around the response to COVID to once and for all get it under some kind of control. So that 400 billion that's been allocated, or we expect will be supported and allocated for vaccines and testing, is really where we see our strongest opportunity.
Okay, thank you for that. And Infinibyte just seems like that is a huge opportunity for the company. Can you talk a little bit more about what that product really enables DLH to do? Kind of what are your competitors there, and what are the advantages of the DLH offering vis-a-vis the competitive offerings?
Yeah, so the competitive offerings tend to be much more of an infrastructure as a service offering as opposed to a platform. And so our sense is that what our government customers are looking for is the security that's offered by the technical solution, but they also need some measure of cost predictability. And so when you're doing just an infrastructure as a service, and you're accessing some of the more household name solutions right off of a schedule that's really offered as at a commercial price, the problem with that is the ultimate cost is very unpredictable and very variable depending on the volume that you need to run through that solution. So what we offer is instead a platform environment for people to operate their business in that they can get predictability, and we're going to provide the services of doing the things like patching and upgrading and backups and all that as a platform offering. And through that, they can predict the cost of the offering to them. So, and it's fitted with our customers in mind who generally handle petabytes, very large quantities of data and need access to it across a broadly distributed scientific workforce. So that's a nice teaming of the technology solution to the scientific community in a way that lets them be responsive to their data analysis needs.
Got another question here, two-parter. What level of organic growth should we expect over the next year? What will drive the organic growth? And the questioner wants to know, did you receive incremental funding as a result of the latest stimulus bill?
We certainly did in the first stimulus bill, and then the one that was done at the end of the year was really focused on individuals more so than anything else. But now in the proposal from President, I guess we can now call him officially President as opposed to President-elect Biden, with the $1.9 trillion that he talked about last week. Of course, that has substantial additional funding opportunities for the programs that we're pursuing. So, all of those are channels for us. In addition, several of our currently existing programs have room to be modified and expanded to accommodate COVID support. So we have both a channel through existing contract base. So if I talk about the contracts we picked up through the S3 acquisition, for example, there's a cadre of contracts in there that are what's called IDIQ. So it's a allocation of $100 million to this program over 10 years, but then you have to get that $100 million allocated to you by pursuing different little projects and tasks underneath that $100 million umbrella. But in those cases of those core contracts in that company we acquired, though you have to compete to get the tasks and get funding allocated to projects, you're the only company competing. You're not competing with the overall contractor community. It's a single award program, but you define work that you're going to perform underneath that. So there's room within all of those contracts to grow and add on work within the amount already allocated to those contracts. And we expect that to be a significant channel for us.
Kind of a follow-on to that, you mentioned in your prepared remarks that you're, operating at a roughly, 10% EBITDA margin today. We're the kind of at the high end of the industry. Given that you continue to move up the value stream, do you think that number can go higher? And if so, where do you think you can get that to?
Yeah, I would more so rather than signaling significant, of course, it's my daily job to focus on improving my margins, and I continue to do that. But I would want to guidance expectations that as you pursue some of these bigger jobs, in some respects, some of the reason why we're on the higher end of that margin is because we're doing some fairly niche-y programs, I would call them. So if you're going after things that are broader and more, and as you're growing up to these larger programs, there's going to be stiffer competition, and the margin pressure might be more significant. So I think what I would tend to guidance people to, or how I think about the business and growth, let me put it that way, since we don't provide guidance, but how I plan for growth is, let me plan that I'm going to stay in an aggregate 9.5% to 10% margin range, but I'm going to be growing the top line significantly, and that's how I'm going to deliver additional EBITDA, as opposed to all the while that I have a background program working to continue to wring out the EBITDA margins.
Okay. And not to put you on a spot here, but we're going to put you on the spot again. Acquisitions, you demonstrated that you grow by acquisitions. You've had some, phenomenal acquisitions that you quickly pay down debt. What's the pipeline look like for you guys? If you were to consider additional acquisitions, do you have preferred areas in which they would go, or target? And I would assume, you at least in the near term, would kind of want to digest Irving Burton. But, any timing of when you think you'd be back out in the marketplace?
Yeah, good questions. Yeah, we certainly never stop looking, and conversely, we're never pressed to do an acquisition. We feel like we have a very well-rounded and stable book of business now, and we've been able to be intentional and deliberate about how we've done acquisitions so that we stay in our thematic healthcare, right? And now we've rounded out the healthcare. But, though, for example, Irving Burton was really important to us in terms of continuing to expand our presence in the defense health market, by no means would we consider that we're done there, so that defense health continues to be important to us, and there are other customers within that focus that we would be interested in building a position with. So that would be another potential area of continued growth. I would say technology delivery with focus on healthcare is going to continue to be of interest to us. Digital transformation is a key area that we're growing and developing our skills in, but if we found a acquisition that was a nice accelerator to that, that would be a prospect for us. But we are on a journey where we are, continue, while we are proud of how far we've come, we definitely view that we have just that far to go and substantial upside in that growth pursuit. So acquisitions will continue to be a key part of that. We never really stopped looking. So I had books going when we closed Irving Burton, and I've had books since then. So I'll continue looking. Realistically, we've got Irving Burton already incorporated into all of our financial systems and benefits plans and all that. So we're ready to go in terms of, if the right opportunity came along, we're prepared to take it on. It's hard to time these things, but I wouldn't expect that it's going to be terribly long before we do another transaction.
Okay. Now we've got a couple of minutes left here, Kath. So I'm going to throw the 10,000-foot broad question here. What are your biggest challenges for the company to achieve its goals here over the next couple of years, and how are you going to overcome those?
Yeah, I would say, well, challenges is always competing for great leaders and strong talent, right? So it's a competitive marketplace, and particularly right now, that's of course there are so many COVID opportunities, and it's great to win them, but you have to staff them and pursue them. So staffing, and we're a people business. So finding the right resources that really know how to really accomplish the service delivery we sign up to is really, really key, and really people who know how to take advantage of the opportunity you have to really provide that subject matter expertise and leadership on key programs. But, this is what those folks live for, right? They're all, no one's happy about COVID, but everybody's thrilled to be a part of contributing to the solution, of course. So, key to us is hiring the right people. Secondly, I would say it's not so much really a problem for us as it is an opportunity. Is really to now, the breakout event for us is to, as I said, we're quite pleased with how each of these acquisitions is performing independently. What we view as the real breakout opportunity for us, though, is to have pursue and capture an opportunity that leverages our capabilities across the enterprise. And that's going to be, that'll be a really meaningful day for us when that happens.
Well, Kathryn, thank you very much. This has been very informative. Much appreciated for you taking time out of your busy schedule to present here at NobleCon17. We look forward to watching the company grow into the future. Thanks again. Say hi to Zach for us. Have a great day.
Sure will. Thanks, everybody, for your time.